Get started.
Sure. We
And
can
we'll go
start
from
with
there.
introductions. So, hi everyone. My name is Giovanni Caruso. I'm a partner with Loeb and Loeb. I personally have been working on SPACs for about 15 years, ever since I started at Loeb and Loeb. So it's been an especially fun ride the last year and a half or so. And I guess I will pass it on to Eric Gomberg to introduce himself.
Sure. Hi, I'm Eric Gomberg. I head the SPAC banking practice at Odeon Capital, which is a boutique investment bank. I joined the firm about 2 years ago. We've been very active in the space, underwrote 8 IPOs last year, have a very significant backlog of deal flow this year, also working on really the full life cycle. So working on the merger side, the de-SPAC pipes, kind of touch all pieces. Probably unlike many bankers in my prior life, I actually ran a fund, a fundamental investing fund, where we were very active in SPACs, participated in pipes at the time of business combination, had a fundamental view at a time when SPACs were far less popular than they are today. So I've been around the product as well for a very long time.
Great, thank you. Stephen Fletcher.
Hey everybody, Steve Fletcher, great to be here with everybody today. My background prior to doing SPACs is I was an investment banker for over 20 years, about 10 years at Goldman Sachs, and then I co-founded a firm called GCA Savian. 3 years ago, I started a business called Explorer, and Explorer sponsors SPACs. So far, we've been focused on the technology market, but sponsors SPACs in partnership with A-plus caliber executives from the technology industry. So far, we've taken 5 SPACs public and announced, closed one de-SPAC and announced another. Looking forward to sharing thoughts with everybody.
Great, thank you. Steve Cannon.
Yes, hi, Giovanni, can you hear me okay?
Yep, we can hear you.
Great. So I'm the managing partner of a small firm called SPAC Partners. I too am an ex-investment banker, a couple of decades on Wall Street, and then ran across SPACs in 2004 when I was heading up an investment banking practice in China for a firm. So I've been doing SPACs now for about 16 years, and I have been part of the sponsor team of 8 SPACs. About halfway through, I formed this firm, which our strategy for the last several years has been to co-sponsor SPACs with either vertical domain experts or geographic experts. And we provide sort of the turnkey solution for those who want to launch SPACs, such as our prior speaker. And, you know, we've done a number of international SPACs, we've done domestic SPACs. We just IPO'd in December, a domestic SPAC focused on consumer products, and we are IPOing next month a technology SPAC backed by a couple of amazing executives in Silicon Valley, which I think is going to be very, very exciting. And very excited to be here today, and happy to take any questions.
Great, thank you. And Rob Gottman.
Last and least. Hey folks, Rob Gottman. I too have been involved with SPAC since 2003. Prior to that, throughout the 90s, I was trading warrant arbitrage and convertibles with a lot of the micro cap deal flow from the 90s. And when a lot of those, firms that were putting out that product were, excused from the dinner table, I needed to wait to, see if there was another opportunity for me with warrants. In about 2003, I noticed a whole sludge of new warrants that were trading, and I sort of tried to figure out where they were coming from. And I heard about this product called SPACs. I was introduced to an underwriting firm who was doing a lot of deals at the time. I paper traded myself for a couple of years, invested in quite a few of them myself, and realized that the dynamic of being able to get your money back and keep a pile of free warrants was really up my alley. And I realized that there was definitely an investment opportunity from the trading side. I launched a small fund called Blank Check Capital in 2007, and it is still in existence today. And I also invest money for high net worth clients with the same exact strategy under an investment advisory. So I bring a different perspective to the table.
Great, thank you. So,
So before we get started, Giovanni, I just wanted to tell
please
you
go.
that we finished this poll of what people are interested in hearing about. So you might want to take a look at it. So what are the most important considerations when investing in a SPAC? 43% said they want to hear about that. 39% said what sort of timelines, durations should one expect when investing in SPACs? And what are the chances for a failed SPAC was the 35% of the people. So just for reference point of view.
Perfect, thank you. Yeah, I have that there. So to start off, I think we all know how active the SPAC market has been. There were 248 SPAC IPOs last year, $80 billion raised. For those who maybe aren't too familiar, if someone could give a brief summary of what a SPAC is and why it's attractive for investors. Eric, you want to start with that?
Sure. So a SPAC, you call it a blank check vehicle or a blank check company, a special purpose acquisition company. It's a pool of capital that is raised by a team, a sponsor with an expertise generally in the sector, with some very interesting deal flow, with capabilities, having been C-level executives, having been a successful private equity fund, having been successful VC, someone with an expertise that investors put in. Again, blank check, they don't know what they will be getting, but it's kind of a treasury with a call option attached. So an investor puts $10 into a unit, and the market exploded last year, and there's nothing unique to last year. I mean, the facts I'm laying out were true the year before and the year before. $10 goes into a trust account. It's unbreachable. And there is a period of time for which a sponsor is looking for a target company, and they're doing a SPAC because they believe there are viable target companies that if they had a vehicle, they could go out and pursue an acquisition or a merger. And there will be a vote. There's a prospectus. There's a deal that's found and sourced, and investors have an opportunity to vote yes or vote no, keep their capital in, or they can have a vote to redeem their shares should they choose to. But again, it's really a vehicle by which new companies, private companies, can go public. So again, if you're a private equity firm and you see thousands of deals a year, and some of them don't need 2 years of restructuring, they don't need to be turned around, they don't need to be fixed, but they're a place where you would like to deploy a large swath of capital. A SPAC is a great vehicle, and you've seen private equity firms like Gores Group and Texas Pacific and many others who have started SPACs with the idea that they have things crossing their transom day in and day out that are interesting public companies where they believe they can add value, and the SPAC provides a method to provide capital, growth capital to those companies. And for an investor, for a day one investor, someone who invests in Rob Gottman and Blank Check Capital, it's really a treasury alternative with, at least last year, a high optionality to the upside. With anything goes right, these stocks. And then when I was on the buy side and I had my fund, a deal got announced, maybe it trades to 10.50. Now you have a deal that was announced today, it's trading at 21 before anyone even gets to perform any fundamental analysis. So it's really, I think, come into the mainstream where many institutional investors are getting involved in funds because it is such a nice cash alternative with so much upside optionality.
And I'm sorry, did somebody want to chime in there? No. Rob, so what do you think about when you're investing in a SPAC? What considerations do you take into account?
So I think Eric made the most salient point already for me, and that is, until last year, I would have been thrilled, and I was thrilled to get 1040 or 1050 for every share of common that I owned. This is assuming that I own units, whether it was in the IPO or in the secondary market. And, so I was I guess one of the original members of what is now referred to as the SPAC mafia, in that I was a no voter. I was never planning on holding shares of stock through the merger. As Eric said earlier, this is a treasury alternative, a cash management tool where you really have the risk profile of a treasury bill with the upside of an equity vis-a-vis the warrant. So historically, I would have, I was always very happy to tender my stock back at the end of a SPAC and get my money back plus accrued interest and be left with a low to zero cost warrant that could hopefully go to $1 or $2 at some point in the future. Nowadays, it seems like I'm disappointed if I sell any of my shares of common stock for less than $12, which is completely, it's sort of gone the other way. And as far as what I look for is really a lot of diversification, because what I've realized is that you can do as much homework on these sponsor teams as you want. You just never know where the 30-40% return is going to come from. And I think it's important to have a diversified, it's just like any other asset class. You want to own a lot of these. The more that come out, you just have to spread yourself out. Until last year, it was very easy to be concentrated in certain names when there were only 20 or 30 or 50 publicly traded SPACs. Now there's close to 300. And it's important to be diversified, just like with any other asset class.
Giovanni, could I follow up on Rob's confession of being a no voter and tie that to one of the questions about, sorry about the dig there, Rob, Rob and I are we're partners when we both like a deal, but we could have been on the other side of the table if we didn't see eye to eye on the deal. But there was a question about what are the chances of a failed SPAC, and that touches exactly on what Rob's point was, which is it was much more common until last year for people to redeem. Obviously, success begets success, and so with these stock prices performing, people are much less inclined to redeem, because who wants to take a stock that's in their portfolio at $15 and basically tender that or give that back to the company to take $10 in cash? So whenever the stock performs materially above $10, you're not going to see redemptions. But another important point is for those out there in the audience who are thinking of getting into SPACs, the SPAC had a fundamental change about 5 or 6 years ago, in that this right to redeem and get your $10 cash back, it used to be tied to what your vote was. You had to vote no, so you had to vote down the merger in order to get your $10 in cash back. The structural change a few years ago bifurcated the vote. You could either vote yes or no, and then you could vote whether to get your cash back or not. And so, except for the present environment where all stocks trade through the roof, it used to be the case that you would bring a company fairly valued at that $10, and then people would decide whether to hold based on the upside. And that determination of the vote, the no voters, as Rob confessed to be, was very critical. And that used to be the hurdle and the obstacle to get these deals done. And that's no longer there. That's no longer the risk, because of the following point. Pretty much all of your common holders will also hold one of the derivative securities. These days, thankfully, it's just warrants, but it used to be warrants and rights. And they're not going to vote no on a transaction to get their cash back if that means it's going to make their derivative security go to zero. So you'll see that deals where there's 90% redemption for the cash, you'll still have 90+% affirmative to approve the merger. And that removed a lot of the risk in SPACs for those investing in SPACs who said, well, I can redeem and it doesn't matter, at least I'll have a warrant to provide me some return on my capital for the period I held it. So that was a long-winded connecting the dots, but I think that's important to understand when you try to understand what the risk of a SPAC is prior to the merger closing.
I would highlight, and this actually goes separate from the risk, but I would highlight, one of the reasons we've seen the explosion in SPACs, not that it's changed, but is a realization that the economics of sponsoring a SPAC are quite attractive. And so I think from a family office perspective, for many of the people on this Zoom, figuring out how to get access to those sponsor vehicles and sponsor a SPAC is one of the interesting aspects. And the rough economics, it's not exactly right, but rough economics are the sponsor puts up approximately 3% of the IPO size and gets approximately 25% of the IPO size as a promote. So you put up for a $200 million IPO, you'd put up $6 million of at-risk capital, and you would get, again, for the same $200 million SPAC, you'd get $50 million of promote capital, as well as potentially getting that at-risk capital back. So that the upside downside risk for the sponsor is very significant. Now, the partner company or target company is going to try and negotiate some of that away, and the market's going to try and negotiate some of that away. But regardless, the upside downside risk is definitely skewed in favor of the sponsor. And I think thinking through, and I'm happy to talk about that if people have interest in it, thinking through how to get access to that sponsor risk capital with the high return profile is probably a pretty interesting thing for family offices.
So, Steve Fletcher, what are you looking at as your timelines for completing a deal, and how do you view the risk of failing?
Yeah, Giovanni, good question. And I guess that was one of the questions that the audience was interested in. So in general, SPACs have 24 months, although if you do an IPO into a rough market or you have a less talented team, that could get shaved back to 18 months or 15 months or even 12 months. But assume 24 months. Certainly our goal for our SPACs is to get a transaction announced inside of the first year and then closed within 3 months of that. There's a lot of value to speed in getting these done. Most importantly, for us as a firm that's sponsoring multiple of these and working on a number at any one time, velocity is important. I would say also from a sponsor perspective, when you are earlier in your life, you have a lot more ability to negotiate hard to keep a significant portion of your promote. The closer you get to the shot clock running out on you, the more likely you are to give up a significant portion of your promote. So, we think it's always best to get these things done within the first year if possible. And
I would just add to that what we're seeing among the teams that we've underwritten and what we're seeing on the target side is just as Steve said, a much faster velocity. And I think a part of that is if you have a high quality team, there's actually going to be quite a bit of inbound, particularly these days. But I think, big picture, if we looked, literally even 12 months ago, 13, 15 months ago, and you talk to 100 private company CEOs about raising a significant vat of capital, raising $200, $300 million, potentially going public, potentially doing a D or E or F round. And you said to 100 guys, you want to do a SPAC, 95 would have said, what's a SPAC? And 5 would have said last resort. And it's been, it's in the Wall Street Journal every day. It's on CNBC every day. It's in Reddit and TikTok. People are talking about SPACs left and right. And so if you're a private company, you're a VC or PE who would have vomited on a SPAC 24 months ago, it's in the playbook. So, last year, as you said, 80 billion plus was raised in SPACs. The record year was a year before, 13.6 billion. Last year was more than 2x the entire prior decade. So I get asked a lot, are there too many SPACs? And I think at some point we'll hit that crossover point where there's 1,000 SPACs and it's just become insane. But I think the question is, there are thousands and thousands and thousands and thousands of privates, most of whom would never have considered a SPAC, who are now very much considering a SPAC. So I think part on the getting back to the point on velocity, if you don't have to spend 2, 3, 5 months chasing someone down, trying to convince them what a SPAC is and why it might be an interesting path, and you even have them beating down your door coming to you, that's going to increase the speed. And what we're seeing guys announcing deals, 60, 90 days after an IPO in many cases, which calls into question the level of diligence and vetting, and that's a separate discussion. But that said, there's clearly just tremendous deal flow, and I think top tier teams can find very interesting transactions very rapidly, which again, for someone like Rob, who's investing in SPACs and looking for yield, it improves your IRR significantly if you see your stock jump higher, after 90 days rather than after 9 months.
So, Steve Cannon, you talked about working with different sponsor teams. What do you look for in sponsor teams?
Yeah, so our model again is we become a co-sponsor of the SPAC. So we don't take any fees. It's purely a success-based model where we share in part of that promote that Steve was describing. And so what we have done in the past is we helped a $50 billion PE firm out of Shanghai launch their SPAC business. Like many Chinese-based SPACs, that didn't turn out very well. Then our last SPAC that closed a merger, we acquired what was the preeminent oil infrastructure assets out of the United Arab Emirates, owned by the royal family of Abu Dhabi, the ruling family there. So, I guess we initially focused a lot of time on international markets, and we were a few folks doing that. And so we had the good fortune of finding some very high caliber partners. When we shifted to the domestic market a little over a year or so ago, we, with the track record, were able to attract some good teams. I think, the key for us is, as I said earlier, either, true domain experts in certain vertical industries or, a geographic expert. So for instance, we've got incubating right now one of the preeminent PE firms in the Middle East. And, the Middle East is the owner of a lot of businesses, as people probably are aware. And what was commented earlier was, how much time you spend working with targets. So having the good pedigree of sponsors helps tremendously with that. But it also helps you with, finding situations where there aren't 3 other SPACs, calling on the same company. I think the term these days is called SPAC off, which is a knockoff on a bake off in the PE world. And so, the caliber of firms helps with the velocity that you were talking about. It also helps with the quality of the companies. So does that answer the question, Giovanni, or are you getting to something else?
No, I think that
Okay.
That's exactly what we were looking for. What given all the deals, and we've talked about how important velocity is, do we think that with having so many SPACs in the market and more coming online, I think in the first 2 weeks there have been 30 deals that have priced at the beginning of this year. Are deal times going to slow down? Are people going to still find good targets? Rob, do you have any thoughts on that?
So that's more of probably a banking question. The only comment I could make on that intelligently is I don't see it necessarily slowing down so much because of the 2-year clock. And I think if you're ready to bring a SPAC out to the public market, I think you're better off having the clock start. And if the 2 years goes by and it looks like you're having a hard time locating a target, you could always ask for an extension of the shareholders. It's not something that's happened too much in the past year or so, because there's a lot of deals that are being announced rather quickly after IPO. But I don't see the number. I think there's another 61 in registration now. I don't know what would make it slow down. that we know of. That's correct. There were just 7 more last night after the close that were filed, I believe. And listen, I also believe like Eric, and I'm not a banker, but I believe there's a lot more than 260 companies that want to be public that are not, and would be very, very happy to go the SPAC route.
So Eric,
And,
Maybe I'll jump in
Go ahead,
as,
Steve.
as well on that one. So people ask me every day, and again, I'm focused on the tech sector, but I think about it this way. There are in the tech sector 2 to 3 dozen tech IPOs each year, and there have been for the last 4 or 5 years. So 25 to 35 tech IPOs a year. That is a relatively small number compared with the 600 so-called unicorns in venture portfolios, and then the probably at least that number of $1 billion+ tech companies in private equity portfolios. And so whether the number of $1 billion companies is 1,000 or 1,200 or 1,500 or 2,000, it's a big number. Let's just call it somewhere between 1,000 and 2,000. And with 2 dozen or 3 dozen IPOs a year, you're just barely scratching the surface with 2 or 3% a year being taken off that list by the IPOs. And then when you add in direct listings, that's another 2 per year. So now you're getting from 25 to 27 or 35 to 37. And when you add in SPACs, approximately 25% of the SPAC market is focused on tech. And so 280 SPAC IPOs last year, 70 of those focused on tech. So when you add IPOs, direct listings, and SPACs, you're now up to about 100 per year, which gets you to somewhere between 5 and 10% of that 1,000 to 2,000 company list of $1 billion+ tech companies. So we think that the opportunity set is very large, and there's certainly opportunity. Now, do I think there's opportunity for 1,000 SPACs a year? No, but is 100, 200, 300, 400 swallowable? Absolutely.
Eric, are you saying you think the pace will continue at its current rate?
Yeah, I mean, I don't know how long it persists, but I very much agree with Stephen's comments that there are plenty of viable targets who are now interested, if not eager, to transact with SPACs. So I think there is it's a very fertile time. Personally, the number of inbounds that I am getting from prospective targets is exponentially changed from 12 months ago. So if that's a microcosm of what the market looks like, then that would leave me very optimistic. And I think beyond what Stephen said, one of the unique attributes of a SPAC. So the market opportunity may actually be somewhat bigger than one would think from an IPO market, in that a SPAC allows in your S4 as opposed to an S1, it allows projections. So, and this is something that clearly was taken advantage of last year, and it looks like it will continue to be utilized. And this is not a rule change. It's just something the market has gotten its arms around and gotten very excited about, that you could have a company with limited revenue, limited operating history that may have very exciting prospects, and you're allowed to show your projections for 2023 and 2027 and 2099. And there are a number of very early companies that are talking some very large hockey stick numbers and going to market based on that. And in a traditional S1, that's really not viable. You can talk about the market opportunity, but you can't show these numbers, for 2025, 2027 and such. So there are a lot of guys in portfolios that may not be viable IPO targets, but have become viable public company targets via SPAC. It's a separate discussion whether all these numbers have truly been vetted thoroughly, which is probably something most bankers wouldn't say. But it's really an explosion in enthusiasm. I'd say it's tied to 0% interest rates. So if someone's going to make $1 in 2029, it's worth $1 today. And given the success of Tesla, the possibility of upside optionality, the possibility of upside skew to an outcome, I think has generated kind of enthusiasm around these very romantic, very sexy stories. But again, I'd agree with Stephen that there are, no shortage of interesting targets. And I think as much as I'm a little cynical in terms of some of these very high growth stories, I think the success of the SPAC market is bringing some very high quality stories to the fore and has made them very eager to transact. And it used to be people would look at you funny if you went public via SPAC. And now, why wouldn't a terrific unicorn, sub-unicorn fintech merge into a great fintech sponsored group? So I think there's certainly no one looks twice at you if you go public this way. So I think there's going to be continued momentum into 21. And as Stephen said, if we get to 1,000 SPACs, that's probably far too many, but I think there's plenty of headroom for a lot of growth this year.
Just to echo Stephen and Eric's comments, between the 2 weeks when we filed publicly our last SPAC and when we priced it on December 21st, we had almost 200 companies reach out to us. That was 2 weeks prior to the IPO, only 2 weeks prior to the IPO. The point that was made earlier about sort of where's the limit on the SPACs? It used to be the case that it was that that SPAC investor mafia that Rob reportedly was part of. There was a decade there when it was really a handful. I used to say it was like 30 or 40 hedge funds that really understood SPACs and sort of maintained the market. And that was sort of the check, when those guys, were full, when their portfolios were full, then you would see a slowdown in the amount of issuance. Obviously, the amount of capital being allocated to SPACs has expanded dramatically. But the other thing was, people's view on those derivative securities, the warrants, right? Were the warrants worth enough to compensate you, not so much for the, for allocating your money into essentially a treasury equivalent, because you'd always have some cash allocation anyway, but to compensate you for the time value of money, right? So whether you were trying to generate a 20% return or whatever. So if you're just going to get treasuries on the common, what does the warrant have to be worth? And with the recent stock performances of SPACs, these warrants are worth a lot. One thing that hasn't changed recently is the exercise price of these warrants. They continue to have $11.50 exercise price, which is sort of a holdover of maybe 10 years ago when it took a couple of years to get from $10 to $11.50. Now if your stock, I think it was commented earlier, maybe Rob said it, if the stock's not, in the mid-teens after you announce it, before anybody can even look at a proxy and analyze the company, it's not a hot SPAC. So that the value of these warrants is just tremendous at the moment, which is driving a lot of capital to this. Those may get repriced. There may be other ways to limit the amount of capital. So I think there will be some breakers on how many SPACs are created, and I think it'll come down to the quality of the team, as Eric was saying. Or maybe it's Stephen, and I think what you're going to see is just like in any other financial sector, whether it's PE or VC, there's going to be a very diverse group of people participating in it, and it's going to come down to track record and skill sets of the participants. So,
do you guys have a notion of how much how institutional this is? I mean, is it family offices? Is it institutions? Is there a tax advantage aspect to it? Can you discuss that?
Well, I guess, I don't know if it was directed to me, but just real quick on the risk capital side of it, there's absolutely.
Because you said there was hedge funds that were involved earlier, and there was like 30 of them. How big are they?
Well, I think
on the risk capital side.
I think the origin of the investor community was hedge funds, because this is a very complex structured instrument. In fact, I think a lot of the retail investors today that are buying into SPACs really don't understand the structure. They don't understand how the risk of a SPAC changes over time before they announce a target, between target and merger and post-merger. So it was a hedge fund mafia, excuse me, Rob, because they were the sophisticated investors who could understand it, and it was a new product, right? So that made sense. And also, I think the highly engineered aspect of the product allowed for it to be played in many different ways. There are a lot of different strategies to play SPACs. Do you, after the IPO, do you keep the common, sell the warrants, or do you inverse or what have you? So that's why I think it originally was hedge funds. For family offices, I think the advantage here is because you are buying that sponsor promote for essentially its nominal founder value, you get long-term capital gains in your sponsor capital, risk capital investment. And family offices could very easily mimic what some of the hedge funds do, which is they participate in risk capital of SPACs. And then they also buy on the IPO. Good high quality hedge funds will be anchors in the IPO. And the combination of that risk capital at a much lower basis and the public allows you to do even more trades or scenarios. So, I think it's absolutely appropriate product for family offices today because, you've got the downside of getting your cash back. So if there's in the earlier panel, the question was asked about a black swan. Prior to a merger closing, if there's a black swan event, you should be able to feel very comfortable because, as was said, your cash from the IPO, the $10 that you purchased the SPAC at, is sitting in a trust account. The sponsors of the SPAC can't even touch it if they wanted to, and it's in treasuries. And I remember back in 2008 when the buck was being broken or was broken and SPACs were trading at massive discounts, but every one of those SPACs, the trust held and people got their money back with treasury. And so, I think you can sleep well owning a SPAC. And then at the merger, you have to decide whether you want your cash back or whether you want the long-term equity upside of the business.
So someone from the audience asked about what type of economics limited partners in a sponsor would be able to get. Steve Fletcher, would you care to speak to that?
Yeah, so the promote dollars are generally for the people who put up the at-risk capital, who sponsor the SPAC and are the management team. And for family offices to get access to that, I think they, in general, need to know the people that are sponsoring SPACs. On occasion, bankers will find people to invest in that. Eric, you probably have a few opportunities where you work with SPAC issuers who are looking for capital. I'll give myself a small plug here if anyone is interested. My firm sponsors the risk capital and gets a very significant portion of the sponsor promote from each transaction. And we are interested in investments from family offices. So if, my email is in the chat. If anybody wants to talk to me about that, I'd be happy to do so. But I think in general, you need to be talking to people who are sponsoring SPACs to get access to that kind of risk capital.
Right. I would just echo that there are cases where there are teams that may have 4 million of 8 million spoken for. And again, unlike a typical IPO where the cost of the IPO is borne out of the proceeds of the offering, in a SPAC, the underwriting fees and operating expenses come out of sponsor dollars put up by the sponsor, and they from time to time will syndicate lesser or greater amounts, or they'll put it up all by themselves. But there will be occasions where there is an opportunity to get involved. It's not widely advertised. There certainly are family offices who I know who have said, if there's an opportunity to be in with a very strong team, that they want to be involved. So again, that's an area where I'm happy to talk to folks, but it's very much case by case. It's not kind of an open, transparent market. It's more if you can get access to a great team, the economics are quite compelling.
Agreed. How we've sort of been talking a little bit of how the SPAC market has become more accepted really over the last couple of years as a real alternative to the IPO market. And the IPO market last year was fairly, well, not as robust as it was historically. How much do you think that impacted the rise of the SPAC market? And do you think that if the IPO market comes back, the SPAC market's going to be is going to decline. Anyone?
Well, I would just point out that, SPACs existed as we know for 25 years. I mean, they first were a it was always a special purpose acquisition company, although they no longer do acquisitions, it's just reverse mergers. But I mean, they were structured quite differently than what they are today as far as the economics and the derivative securities. But for years and years, I competed against traditional IPOs, right? When the window was open, when the window wasn't open, when the IPO window wasn't open. I think the arguments that were compelling then will be compelling again, even if the U.S. public market IPO window opens up, and is easier for people to access. And those compelling arguments were, a SPAC transaction gives the target company and its shareholders control of the IPO process. Once that target company reaches an agreement with the SPAC, that agreement can be structured such that there are low to no condition precedents to the merger closing, i.e. them becoming public. Whereas, the traditional IPO process, for those in this meeting who haven't experienced it, I mean, some companies can take a year and a half, spend millions of dollars, and then whether or not they get public just depends on what the market environment is like that month they're trying to IPO. The SPAC market has been much more consistent over the last, at least my experience, last 16 years, for being able to bring deals and close deals regardless of what the general market conditions are like, because of what was said earlier, which is you've got a lot more flexibility given that it's a merger under the 33 Act versus an IPO with strict liability under the 34 Act. So,
okay, there's about 10 minutes left in the panel, so if you guys can address some of the questions that are down in the Q&A and chat, that'd be great.
I think I ticked a couple of them off. I think I got to a few of them.
Just keep on running, guys. You got 10 minutes.
Okay.
Well, I can answer Stan's question, which is pretty straightforward. It's in stock. Yeah, the question is are the promote fees in cash or stock? They're in stock. There's literally zero compensation for the SPAC team. There's no salaries, there's no dividends, there's no interest, there's no nothing. You put up approximately 3% of the IPO size at risk capital, and then you get the stock promote on the back end, which is itself locked up for a year after the de-SPAC transaction.
No, I would comment on the second question, how much is typically left in a SPAC post-merger. If I gave you an average, that would be maybe statistically right, but completely wrong in terms of what actually happens. On average, it's probably 30, 40, 50% left, but in actuality, it's pretty much binary. If especially these days, if a transaction goes well, and lately almost everything's been going well, if you see something trade to $12, $13, $15 and there's 10 in trust, if you don't like the deal, you're selling your stock at $15 unless you hit the wrong button, which happens like 0.1% of the time. You're not going to redeem for 10 if there's $15 in trust. So if it trades well, there's going to be zero redemptions. If it's kind of an iffy transaction, of which there have been relatively few lately, there'll probably be 99% redemptions. The ones in the middle where you see something immediately trade a dime, 2 dimes, 50 cents above trust, where you have some fundamental investors who want to own the stock long-term, buy in, and then that's kind of all the demand there is, and it rolls back to trust. So you have 50% redeeming and 50% who are actually fundamental. That is the few and far between case. So most of the time it's completely binary. In the old days being 2 years ago, you'd have deals where there was 10 in trust and the stock trading at 10.09, and very much to Stephen's point before, that you could have you can vote yes and then redeem. So you'd have 99% vote yes. You'd have a deal cut behind the scenes with a pipe done down at $8 or $8.50 or $7 with the sponsor sweetening the deal. And then you'd have everyone except for a few guys who got that deal redeem. These days, most of the time, the pipe there, and this has become a far more institutionalized product where an LOI gets signed, and between the LOI and a definitive business combination being announced, there tends to be validation by institutions, by the Fidelities, who 2 years ago weren't playing SPACs at all, or T. Rose, or major name brand institutions that everyone has heard of, participating in a pipe at $10, basically a roadshow deal. And at the time of the business combination, it's announced that there's 200 million, 100 million, 5, whatever the number may be, that there is cash there to close the deal. And everyone says, Fidelity is involved, we're going to get behind this too. And it's also another place where family offices can from time to time play in pipes if they have relationships with banks and know that this is on their radar screen. But again, I'd say it's kind of like 100% or 0%, and very few that are much in the middle on that question.
Yeah. And speaking to the issue of pipes that are coming in prior to announcement of a business combination, I've seen a few deals basically not move forward because they could not get pipes done at what the target wanted as the valuation. So that's been an interesting mechanism to sort of weed out weaker transactions. I don't know if others have experienced that.
Yeah, and I think that's a critical part of the market, Giovanni, is ultimately these transactions are similar to an IPO. If when Goldman Sachs brings an IPO, if Fidelity looks at it and says, we don't like this company or we don't like this valuation, the IPO is not getting done. SPACs are very much the same. If a SPAC sponsor brings a deal to market and the institutional investors don't like the company or don't like the valuation, the deal doesn't get done, and that goes to the point of are there redemptions, and I think people understand that, but in essence, as Eric explained at the very beginning, investors have the option when the de-SPAC is closing to either hold their stock and roll into Target Co, or to redeem for $10 plus interest. Let's call it $10.10 right now in the low interest rate environment. And if the stock's trading at 10.50 or 11 or 12 or 15 or whatever the number is, if you're rational, you're either going to hold on to that stock or you're going to sell it in the market for $11 rather than redeem for $10.10.
Rob, so someone from the audience had a question about building a diversified SPAC portfolio. Any thoughts on that?
So, as I alluded to earlier, until 2020, there was a universe of 30 or 40 SPACs, and it was much easier to perform a little bit of due diligence on sponsors and figure out who I felt had the best path to locating a good target. My strategy really carries a 6 to 9% performance objective. And that is really because, as I stated earlier, I want to invest your funds that are sitting there for a rainy day, so to speak, safe funds that you don't really want at too much market risk. And in case in point, this, I've been doing this now for 14 years now professionally. The biggest drawdown I've ever had was in 2008, which was a little over 5%. 2020, I'd say 80 to 85% invested at the end of February. And my worst account at the end of March was down about a little over 3%. And then I finished the year up about 60. So now that, you can't really ask for any more than that. I would have been thrilled to have finished last year up 9%, 10% after what happened in March. It's, like I said, you really just have to look at it, if there's specific industries that excite you more, if there's specific sponsor expertise that excites you more, you can build a portfolio based on potential target kind of industries rather than trying to figure out which, specific companies the targets are going to go after. It's just sort of owning as many as is, feasible in this environment where you really don't know who's going to locate the right target, and even more so what the reaction of the market is going to be.
Can I just jump in here with a quick question? I mean, so we know that there's like 400 plus unicorns out there, and only about 20 to 30 do the traditional IPOs these days, at least last year, right? So are SPACs really the way that those companies that are looking to move faster and not wait in that long line of unicorns going public? Is that the way they should be going? Should they be looking at alternative stock exchanges like ASX? Maybe you guys can talk about that a little bit. And I know that I think it's Steve that specializes in tech, or but I mean, feel free to address it because it's something that's important. I mean, are the best candidates the ones that are most likely, the unicorns, or could it be any industry? And do you see more and more industries participating? So again, feel free to jump in.
I would just redirect the question. I think the biggest competitive, not threat, but the biggest competitive thing SPACs will deal with are direct listings, right? And there's a significant rule change coming up. It used to be companies doing direct listings couldn't raise new capital. So it was really for the unicorns that were going public for, so that they could provide liquidity to their existing shareholders or for other strategic reasons, as opposed to actually raising capital. With this rule change, I think you're going to see even more companies interested in direct listings. But in my opinion, direct listings will only ever be a solution for companies that are household names and are already very well known. And as anybody who's been involved in the IPO business over the last couple of decades knows, that there's a lot of companies that go public. There's a lot of investor education required, and SPACs is still, I think, an advantageous structure relative to a traditional IPO for those companies.
Yeah, I'd echo that. Again, I think if you're a sub-unicorn and you're not quite that famous, but on a great trajectory, a direct listing doesn't solve getting the narrative out to a wide audience. And also on the same point I made earlier, there are a lot of companies that have absolutely excited the investing public based on what they're saying they're going to do in 2027. And there's no ability to put that message out on a direct listing. So between kind of the notoriety, the ability to market a transaction, the ability to use transactions, I think SPACs stay very viable. And I think, on unicorn, there's no rule that says it has to be 20 or 30 that go public. I don't think there's a limitation that it couldn't be quite a bit
It's
more.
just not that way, right?
Right. No, and so and if you're a unicorn, I don't know why you'd necessarily want to go with the SPAC. But I think if you're something slightly different, slightly less than that, but still on a great growth path, a SPAC has become a very interesting alternative, if not even in some cases, a preferred alternative.
So we only have about a minute left. So can we just get closing statements from each one of you for 20, 30 seconds or so, and just what should we be thinking about in 2021? Are SPACs the future? Is the sky the limit? Or how should we manage risk? So again, 20, 30 seconds each. Let's rock and roll.
I'm going to start real quick, because you struck a nerve with me, Marty, about managing risk, and that is, I've received calls from some of my friends that are not in SPACs. They're not even in the market at all, and they said, "Hey, my broker said to buy these 3 SPACs," and immediately my head starts exploding, and I'm looking, and these are deals that are already trading at 17, 18 bucks. And I said, you're not buying a SPAC anymore, right? You're buying an actual company. He said, and they say, well, isn't that what you do? No, I invest in SPACs when they're trading in the 10s, and I have very limited downside. You want to invest in an actual, company, then you want to buy it at 17, 18, but it's not a SPAC anymore. It's a SPAC still because it hasn't closed their deal, but it doesn't have, no longer has the risk profile of a SPAC. So just understand what it is that you're buying and what your objectives are.
Perfect. Next.
Hey, Fletcher, you want to?
Yeah, I will say, I think SPACs are here to stay. I think it's a, very viable investment platform, whether it's in the units, in the common, in the warrants, or in the sponsor capital. I think this is I don't think this is a blip. I think this is a long-term market that's here to stay.
Eric?
Right, I would agree with both Stephen and with Rob. I think this will be a very fertile and vibrant year with even with the explosion of SPACs on the formation side. I think there's plenty of targets. I think the offset to that is folks should be careful and manage risk, because when you have a press release and a stock doubling within 3 minutes of it, clearly no one's been doing work. This whole panel is old enough to have been around back in 99, 2000. So, there's a lot of froth. That said, I think this has become institutionalized. There are many very viable, enduring companies going the path of a SPAC. So there'll be some real good businesses that come out of this as well. And I think this stays around for the foreseeable future.
Steve?
Yeah, I would echo exactly those points. SPAC's already been here 25 years. My first SPAC as a sponsor, I believe it was one of the last SPACs before the global financial crisis hit. And then my next SPAC was one of the first, at least Asian-focused SPACs when the SPAC window opened back up. So it survived global financial crisis. I think it will continue to evolve. I think the time to get in and sponsor capital is now, because I think the sponsor capital is going to go through a bit of an evolution as the excess sponsors and capital come to the market. But, with the way it's structured, you can hedge your risk as a sponsor by participating in the IPO. And so I think anybody should be looking at it very seriously for a asset portfolio allocation.
All right, well, I think,
Giovanni, did you have any closing statements about SPACs? You kind of been, the shepherd for 15 years.
I think the SPAC market has developed a lot over the last 15 years. I'm very excited by the quality of the people, the sponsors, the underwriters, just everyone involved in the transactions today as compared to 15 years ago. And I think it's great that it's now looked at as a real alternative to the IPO market. I think it's giving a lot of companies the opportunity to go public that wouldn't have had that opportunity, 5-6 years ago.